Alright, good day. This is Festus FX and you're welcome to this channel. Alright, this is gold and this is how I would trade gold on a Tuesday morning. Alright, so first of all, we want to go to the daily time frame and then see what the daily time frame tells us. Now we can already see that we're expecting price to get to this order block. So we expect price to keep going bullish. Alright, so right now we're going to take note of previous daily high and daily low. Alright, so this is a new day, so I'm just going to take note of previous daily high and daily low. So these are previous daily low, and this is our previous daily high. Now you would notice that we already took note of this low that was taken out here when the market opened this weekend. Alright, so this is a fair value gap that the market reacted from. Alright, now we're expecting price to continue to go bullish. Price should take out these highs and eventually these highs by the end of the week. So currently we are going to be looking forward for buys. Alright, so from daily time frame we're going to be looking for buys. So let's just take note of these areas of liquidity we're expecting price to take out. Now moving down to the 4-hour time frame. Alright, so on the 4-hour time frame, this is what we call a draw on liquidity. Okay, on the 4-hour time frame we can obviously see that currently price is making a retracement. Now if you take your Fibonacci from this high, this internal range liquidity to this low, you can see price is currently at equilibrium. So these areas, it's where we want to look forward for buys, below these areas. Now let's go down to the 15 minutes time frame. Alright, so 15 minutes time frame. So on the 15 minutes time frame, you can clearly see that we have this liquidity here, or what we call inducement. This is inducement here. That price needs to sweep out, and then we have this 15 minutes order block here. This is a 15 minutes order block. That price has not yet mitigated. Remember what I told you what an order block is? Now some persons may want to use this as their order block, this last bearish candle we have here, which is also fine, whichever you want to use, but I want to look for ways to mitigate my risk. So if I want to take an entry, from here because of spread, then you can keep your stop loss here or below here, whichever way, here or here. Okay, but I like to minimize my risk as much as possible, so I'm going to be using here as my risk and then take profits here. So this is a 1:6 trade. All right, 1:6 trade. Now if you want to take a swing trade on these, you could obviously hold your trades for our final take profits, which is around these highs, which is these weekly highs. Then your stop loss will be below this. This is going to be a swing trade. All right, you can also put it below this, whichever, or below this, below the other block. All right, so whichever way, let's see how it plays out. Do not forget that market is always attracted to areas of liquidity, and liquidity areas are where we have stop losses and take profits. So you need to always ask yourself every time, where would people keep their stop loss, or where would people keep their take profits, and then you trade in that direction. So let's see how the market plays out for the rest of the day. Make sure you ask your questions, you like, comment, and you subscribe to the channel for more videos like this. Till then, I'll see you in the next video.